The Asia-led partnership was set up to support knowledge sharing and peer learning and increased cooperation among countries in Asia to address issues that many countries and different stakeholders are facing related to promoting low-carbon development as a vehicle for more sustainable and greener growth.
Climate finance is that type of finance which is deployed for mitigation of climate change or adaptation to climate change with the express purpose of reducing emissions or increasing resilience to climate change.
It captures many different elements. It captures mitigation and adaptation, capacity building. It captures various geographical directions, so it captures south-south flows, north-south flows, domestic flows.
The cost of not doing anything on climate change are in the range of 5, 6, 7, 8% of GDP if you look at models of what the impacts would be in the year 2050.
The investments are flowing towards still very high carbon intensive activities, traditional energy and infrastructure projects.
We're working on something that's pretty urgent and really a huge challenge. I mean, we're talking about changing the way that we produce energy, grow food, live, on this planet.
So what we see in our work is that risk, whether perceived or real, is the single most important factor preventing money actually to flow into green investments.
There is some risk appetite in the private sector, but generally the private sector does not like risk it cannot manage. That's very important. So risks the private sector cannot manage are usually political risk, regulatory risk, but also, for example, off-taker risk, creditworthiness of a single off-taker, for example, utility in developing countries.
We're often facing just a lack of awareness, and we're not reaching the right stakeholders to get the message across that these opportunities are out there for making smarter investments that will yield more prosperity, more value, more wealth creation over time.
The good news in Asia and the Pacific is that there are funds flowing to climate change or green financing. The not so good news is that it's not enough, and it will never be enough because of the huge demand for this change in environmental issues.
The availability of donor financing is complex. It's available, but it's very hard to understand where it is or how to access it and what the conditions are.
Readiness is the key for increasing this access to financing.
Currently, also in terms of the government budget, we are in the process of identifying and tagging from the budgetary proposals of the different sectoral departments, because climate financing are distributed across sectors.
I think primarily the success factors have been you need a very strong policy and regulatory framework. We also need very robust methodologies for baselines. We need good awareness of technologies and best practices that are available. We need a very strong MRV, monitoring, reporting, verification system with standards.
Any investment in renewable energy or clean technology is like a three-legged stool. The three elements being: one, the maturity and the viability of the technology; two is the public policy; and three is the investor, who would look for return and commensurate risk.
A good example of an area that I thought was very innovative here were a number of banks and international institutions who are trying to serve smaller businesses, SMEs, and lower income, even very poor, bottom of the pyramid markets with things like solar lanterns and products, and to do that in a commercial way. Not assume that because people are poor that they can't be approached with a commercial product.
There's more than enough funding available. The gap is between the needs of developing countries, say to fund adaptation projects, to fund scaled up renewable energy, to fund sustainable transportation, climate resilient development, between their needs and their ability to access that financing. So in other words, making bankable or investment-worthy projects.